Good afternoon and welcome to the CHECKIT PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to CHECKIT CEO. Good afternoon, sir.
Good afternoon and good afternoon everybody, and thank you for attending the annual results webinar for the full year 25. There's a fair bit to get through, so we'll move very quickly into this. Just to introduce the presentation team, myself, CHECKIT CEO, and also introducing for the first time Chris Shaw as CFO for his annual results debut. So thank you and welcome, Chris. So we've got a few bits to get through in today's agenda. I will start off with the highlights of the year that was FY25 before covering off strategy update, particularly important for those that are new to the company and potentially new investors, before handing up to Chris, who will take us through the financials in more detail. And then we'll cover off the outlook for the year that we're currently in and open up to questions and Q&A, which will be moderated by Alex Schlick. Okay, so we're very pleased with what we consider to be a strong performance for FY25. Just going from the top, so sales performance, recurring revenue bookings, ARR, up 33% year on year to £2.1 million of ARR booked in the year, which we're very happy with, which flowed through to ARR growth of 8% to 14.4 million, up from 13.3. That was dampened slightly by some exceptional churn, which Chris will take us through, where otherwise it would have been nearer sort of 15-16%. Revenue, of course, flowed through very strongly to 17% in the year to £14.1 million. And in line with our sustainable growth and accelerated profitability, we continued with EBITDA improvement by a further 33% down to £2.3 million. Net cash at the start of this year was strong at £5.1 million. A couple of points I'll make here now. Our net revenue retention of 107%, again, we're very happy with. And just as a reminder, our 3-year average around net revenue retention is about 111%. We aim to try and get as close to 110% on an ongoing basis as we can. So again, very pleased with that. It's a very solid example of land and expand at work. And I'll touch on some of the product innovation features that we released in the second half of last year, namely asset intelligence, the ML AI module, and we'll go into that in a minute. Okay, so in terms of strategy, for those that are new to the company, I'm going to briefly summarize and make as clear as I can who indeed we are and what we do. So starting from the top, this CHECKIT's an organization that serves particularly large multinational companies or organizations, companies that have hundreds, if not thousands of different locations, each of which are the same. And particularly we're selling into the operations area, so the chief operations officer. And what they receive, what they get at their level is what I'd call a single pane of glass view as to the operational performance, the operational excellence that exists within their frontline operational footprint. Okay, so think KPIs, think dashboards, think graphs, think predictive analytics, ways of managing cost out of the system. Now that's facilitated by our 2 core products. The first being a sophisticated Internet of Things sensor ecosystem. So in each of these locations, there are built assets. Think fridges, freezers, plasma storage, blood storage, vaccine storage, assets which need automated monitoring and they need automated telemetry reporting. That is facilitated by our Internet of Things ecosystem that provides a wealth of data for the first time for an organization, because this data would have previously been manually recorded and manually checked. So that is an automation opportunity for these organizations. And alongside that, we have a task management platform that sits in the hand of a worker in an iOS device or an Android device or a tablet, and that guides and prioritizes them through their daily tasks, checks, and processes. The 2 products are symbiotically linked, meaning that data is shared between them. So for example, if you're a worker working in a food retail location and an asset fails or an asset goes down, that triggers an automatic alert to the worker who can then respond in real time to resolve the issue, thus preventing things like stock loss or any other further damage to brand reputation that would typically occur in these large disparate organizations. As I mentioned, in both instances, these tools are generating a vast quantity of data that was analog in the first place for these large businesses that has become digital. Okay, so CHECKIT is that first digital step towards a more cohesive solution. On that data, we can then build sophisticated ML and AI modules, such as asset intelligence, which then adds even further ROI to an operational leader by way of cost out or cost efficiency, or indeed operational excellence. And we'll talk on that in a bit. Okay, so if you're new to CHECKIT investment story, I want to call out a few key points here for why CHECKIT's a very investable company in the current market. And so the first thing to note is the market that we operate. So I've alluded to the fact that we specifically sell to large multinational enterprises with hundreds of thousands, tens of thousands sometimes, of the same type of footprint serving their customers. Now, the operational workers that form part of that footprint are typically very underserved from a technology perspective. So whilst there's a lot of noise and hype around the ability for something like generative artificial intelligence to disrupt, knowledge worker SaaS-based industries, ours actually is very under disrupted and underutilized. And so that is something that CHECKIT can bring to bear from an automation and digital standpoint. So we get in there first on the ground, create an automation and digital footprint from which you can then add more value-adding AI tooling to make it more effective. As I mentioned, ours is a company that is successful when we have net revenue retention, so that's our ability to upsell and cross-sell customers at about 110% and above. So effectively, we land a customer at any size within our target footprint, and then we build and scale them over time. So think of someone like BP, who's one of our largest customers. We're in over 1,000 locations now. That's the UK, it's Netherlands, it's Luxembourg, it's Australia, it's New Zealand, and with many thousands more for us to keep going into. And then we couple that with typically pretty low industry leading low attrition rates. So our gross revenue retention number is typically around 95, 96%, and that's where we aim to do. So if we could hit those two metrics, then the question becomes a very targeted approach to net new logo acquisition, and we'll talk on how that's been benefiting the business in a bit. By way of geographical expansion, North American market, particularly the US, where I'm actually speaking to you from today, is our key international market for expansion for reasons that are quite obvious in terms of the size of the market and the homogeneity of the customers. And I'll be pleased to take you through how successful we've been with the US so far in a little bit. Again, this is a business that is a predominantly subscription-based recurring revenue business. And what do I mean by that? I mean that 94% of our total revenue base is recurring revenue now. And that's on a typical three-year minimum term. That's very attractive because it provides stickiness of the revenue profile, a lot of future visibility of future earnings, and indeed acts as a risk mitigant, especially in today's quite volatile macroeconomic environment. And as we mentioned a few weeks back, we delivered an update to the market that we've always been pursuing the accelerated path to profitability. We've chosen to prioritize that as the main effort this year by way of a £3 million annual cost out exercise, which Chris will talk to you of in some detail. So that provides us with a significant degree of assurance around profitability by the very start of next year. So that, again, is encouraging. So the market opportunity, I've touched upon some of the macro factors that are working, but effectively CHECKIT sits at the confluence of two key industries. So the first being the global workforce management market, which is valued at about $11 billion and growing at a CAGR of 12%. And the second is the way that the global smart sensor market, so Internet of Things devices, valued at 65 billion, growing at a CAGR of 19%. And CHECKIT is a leader in both of these, but in particular, the confluence of both of those into a single platform. And the hardware-enabled SaaS component of that makes this a very sticky product with customers, hence the low churn that we typically produce. Now, the workers we go after, so-called deskless workers, frontline operational workers, are still unbelievably, given what's happening, they're still very underserved from a technology perspective. So 73% of them are still using pen and paper to do their work, which is just mind-boggling, really. And where they're not, they're either using Excel spreadsheets or they're using very ineffective tools that don't really speak to each other. And this is the automation and digital opportunity for CHECKIT, because we come in and we put that first layer on the ground from which you can then build up. this pickup provides a lot of meaningful insight for operational leaders to then drive cost out of the system or drive operational excellence. In terms of the markets in which we focus, I'll just take you through the ARR split, so you can see why it is that we do what we do. Healthcare as a space, so think the NHS, think private hospitals, think private care homes, think blood plasma providers. That's 50%, 50, of our ARR now. And particularly sticky industry for us, given that it's a high margin space and it's heavily compliant and regulatory led, and our products provide that first layer of data aggregation into that space. Alongside that, we have about 35% of our ARR coming from food retail. So think again the BP use case, or someone like Dishoom, or Waitrose John Lewis, and then the remainder, sort of 20-25%, comes from hospitality customers, which were our traditional customer when we first built the product, built the company, and it scaled up from there. As I said, the US market is our primary and priority international expansion market. Just it's 5 times the size of Europe in terms of spend. Even now, with a slightly more volatile macro environment, those companies still require automation. They still need to drive costs out. They still need to become digital, and they're very similar use cases to what we have in Europe. So that's very exciting for us. Now, I want to talk to you very briefly about what the growth strategy looks like then. I'll point you towards the top line first. I mentioned the US market and US market growth, and we'll see how that's developing. Again, I'll labor the point around our ability. This is an organization that grows by landing a customer at whatever size of footprint and then expanding that customer over a number of years through upsell, cross-sell, and minimizing the amount of churn that comes through the system. So NRR and GRR are so important to this business. Again, ours is a business with very high levels of recurring revenue, so stickiness and future visibility of earnings. This is important for us. And as we're prioritizing this year, the main effort for this business is to bring forwards profitability as quickly as we can. And we have a lot of confidence, and we'll take you through what that now means as per the cost out exercise that we're currently driving as well. In terms of R&D and innovation, product is still the most invested part of our business. We will continue, despite the cost access, to focus on very specific value-adding innovation opportunities. And where necessary, if there's a customer-led, customer-paid-for opportunity, we'll get behind that. So again, we remain focused on driving that in the business. So the US, for those that are new, we entered the US market about 4 years ago, standing start. And we're very pleased with the progress, right? So it's now 26% of group ARR in the business. The bridgehead has been established. We're in all but 2 states within the US. And from a sales perspective, we've grown ARR in the US 12% year on year. So it's the fastest growing market, which is exactly what we'd want it to be. There's a huge amount of potential here, untapped. We're still got plenty to go after. But what I will say from an investment perspective, we have now built and established a go-to-market leadership structure with go-to-market organic sales and marketing based in the US. And I'm pleased with the progress that we're making. Indeed, we've got a sort of midterm objective for the US to contribute more than 50% of sales in a given year to the business, and indeed in time 50% of revenues. So that's the expectation and the pressure we're putting on the US, but we remain confident with the way we're delivering. I won't labor the point on subscription revenues, but what I will say, of course, is that there's a direct correlation between sales bookings from a recurring revenue perspective and the ARR that generates, and then the ARR that then flows through to recurring revenue, and then total revenue as a whole. And again, as you can see, really positive numbers there, from sort of 8% ARR through to 17% on the recurring revenue, and indeed total revenue at 17%. And then just to touch on GRR and NRR for the year, we report NRR of 107% and GRR slightly lower than we'd normally expect, but still very good at 92%. So I'll take you through a couple of customer use cases to try and bring this to life. And those of us who are watching from the UK and London, who like a bit of spice, like a bit of a boutique feel, will be familiar with a company called Dishoom. Dishoom is one of our favorite customers for a number of reasons. Whilst we're in only 13 locations with them, it's a great example of the full stack of our product at work. So what's going on inside Dishoom, and not forget, this is a company that's now expanding to the US as well. behind the scenes, you've got all of the assets, so the cookers, the hot holds, anything that requires Bluetooth probing and ability to check inventory and better manage your production planning. That's being facilitated by CHECKIT's sensor ecosystem, the telemetry reporting. At the same time, the workers, whose main effort should be serving as much product to customers and indeed driving an improved customer experience, they're able to do that because they're using the CHECKIT task management system to guide them through their tasks, but also to minimize the likelihood of duplication of effort and, frankly, to be able to respond in real time to any outages in their assets, so that what they're not doing is constantly going back and checking things rather than serving customers. All of this then provides a wealth of data that allow Dishoom to make very specific operational excellence decisions: where best to have people working in a restaurant, what types of food and product, how best to minimize the likelihood of wasted stock and wasted produce. And this then drives, frankly, a better customer experience. So they're very happy with us, and we're very happy with the relationship. On the other hand, you might look at someone like the Royal Devon University Healthcare Trust, or even use this as an example for the NHS as a whole. This is an organization where we're in 178 different hospitals, 86 different trusts. Actually, if I were to aggregate the ARR from all of the different NHS locations, it would be our single largest customer, north of £2.3 million of ARR. But what's really exciting about what we do with the NHS, it is a obviously heavily compliant, heavy regulatory-led environment with very precious stock and assets. And so CHECKIT provides what we call an automated monitoring solution for healthcare. So all of the fixed assets that look after critical products such as bloods or vaccines or in pharmacy locations are fully automated and monitored by the CHECKIT system. This then frees up nurses and other workers to spend more time with patients, which of course in the NHS's case is highly valuable given the exceptionally stretched nature of the organisation. Now, so when someone like the CQC will do a snap inspection on an NHS location, for any failed audit, that's typically a £50,000 fine. And so CHECKIT's ability to provide data, and then data that goes back years, as an assurance of the validity of the regulatory exercise, becomes highly sought after. It's a very proven solution, and one from which we can then add some of the AI ML modules that I mentioned earlier. So I'm going to hand over to Chris now, and he'll take you through the financials in a bit more detail.
Thank you, Kit. Just a little bit of background on myself, given this is my first IMC presentation with CHECKIT. I've worked in finance for the past 25 years in a variety of different industries, but my most recent role was CFO at SmartSpace Software PLC, which is another AIM-listed SaaS business. SmartSpace was actually taken private just before I left in a transaction which valued that business at 4 times ARR. I'd like to start off by taking you through the financial highlights. I think that these demonstrate delivery on our core objectives for FY25. First of all, you can see that we had 17% year-on-year revenue growth, taking us to £14.1 million. And secondly, delivery of efficient operations. You can see our gross margin increased by 3 percentage points to 70%, and our EBITDA losses continue to reduce by 33% to £2.3 million. I would say that the single largest contributor to these improvements was the expansion of our contract with BP. We delivered our services to an additional 400 sites in Australia and New Zealand during the year. For me, the value proposition at CHECKIT really boils down to the quality of our earnings. And you can see this from these 4 core pillars I've got at the bottom of this page here. So first of all, our revenue is 94% recurring in nature, giving us a high degree of financial predictability and consistent cash flows, and it reduces our reliance upon new sales to maintain momentum. Secondly, our contracts are typically 3 years in length at the outset, and they then move on to a 12-month rolling contract. Again, this gives us a stable revenue base and reduces the risk of churn. And where we do get indications of churn, we have 12 months to prevent the loss. As Kit mentioned, we have a strong net revenue retention of 107%, demonstrating our ability to execute, land and expand, and our gross revenue retention of 92%. And in fact, if you look back over the past 3 years, the average rate has been 97%. Again, is a strong metric for the business. It's obviously slightly down on in the current period compared to the average over the past 3 years, and I'll go into a bit more detail on what that churn is made up of in the next slide. You can see here the movement in ARR during FY25 is made up of three main constituent parts. First of all, expansion ARR from our existing customer base. We had £2 million of expansion ARR, which represents 15% of our opening ARR position. Secondly, we had £200,000 of new customer ARR during the year. Again, this is a great source of future expansion revenue, and it's also an area which we're focusing on maximising for FY26. The churn and contraction ARR of £1 million, you can see what that's made up of from the pie chart on the right-hand side. First of all, we had £400,000 of churn and contraction from what I would describe as our core customers. This is obviously an area which we try to minimise, but at £400,000, that represents just 3% of our opening ARR. The other two items I would say were unusual in nature. So firstly, we had £300,000 of churn and contraction from low value and low margin customers. A low value customer is what we describe as a customer which typically operates from a single site and with an ARR of less than £10,000. And a low margin customer would be a customer where we have direct costs associated with providing services to that customer, which are also lost as part of the churn process. And finally, we had £400,000 of churn and contraction from what I've described as a prior period tidy up. There's a few different things in there, but as an example, what might happen is a customer will place an order and the final delivered services may be either greater or more than that original order, greater or less than the original order, and therefore it will come through either as expansion revenue or churn or contraction revenue. As we said in the announcement today, we expect our churn to stabilise for FY26 at the levels that we've seen in FY25. And again, we expect a similar breakdown between exceptional and core as we've seen in FY25. This slide shows you the improving operational efficiency within the business. You can see that our gross margin has increased from 54% in FY22 to 70% in FY25. What this means is that whilst we have a 68% increase in revenues over this 3-year period, we have a 113% increase in gross profit. This obviously is what's driving us towards profitability. And just going a little bit more into operational gearing, you can see here that we have a 23% year-on-year increase in gross profit, taking us to £9.8 million in FY25. And at the same time, our operating costs increased by just 5%. This 5% increase is largely a result of inflationary pressure. We have just announced that we're putting through an annualised £3 million of cost saving through the business. That programme has already started. We expect it to be largely complete by the end of May. It's focused on a couple of areas in particular. It is spread out throughout the entire business, but focused on a couple of areas, and those will be both the capitalised and non-capitalised product spend and also go-to-market spend. The impact from this cost reduction exercise will be seen from Q2 of the current financial year onwards, but obviously the full impact will only come through in the next year. And we expect restructuring costs somewhere in the region of £400,000 relating to this programme. This slide demonstrates the progress that we've made in reducing our EBITDA losses. You can see that they've reduced from £6.4 million in FY23 to £2.3 million in FY25. We expect this trend to continue in the future years. So for the current financial year, FY26, we expect to be approaching break even on an EBITDA level. And for next financial year, FY27, we expect to be EBITDA profitable. We are being conservative in our revenue growth assumptions, given the uncertain market conditions. We're not factoring in winning any of the large opportunities that we have in our pipeline, and we're just assuming run rate growth. Revenue growth is also going to be impacted by the reduced go-to-market spend as we focus on profitability. This slide shows you the movement in cash during FY25. You can see that we consumed £3.9 million during the year, which is down 40% in comparison to the prior year, where we consumed £6.6 million. We had £5.1 million at the beginning of FY26. The cost reduction programme, which we're putting through, together with some modest revenue growth assumptions, will deliver us to cash flow break even in calendar year 2026. That's it from me, and I'll hand you back to Kit.
Thanks very much, Chris. Yeah, look, so we're very excited. We're happy with the performance that we've been delivering so far, and we're actually very, very enthusiastic about our ability to drive through profitability ahead of schedule, whilst maintaining the core infrastructure of our go-to-market and our ability to keep growing both locally and internationally. That continues to be demonstrated by a land expand NRR GRR model, as referred to already. The real focus of this business becomes a very targeted acquisition of net new customers, which is something we expect to see more of in the US, but indeed also in the UK. And as Chris mentioned, that is not something we've factored into our modelling. So actually, it's a conservative model, which we'd expect or hope to achieve on the upside. Indeed, the drive to profitability is the main effort of this year, whilst maintaining the sanctity of our go-to-market, and £3 million of analysed cost savings will be delivered, and we're executing as we speak. And therefore, from the board's perspective, we're confident of achieving, if not beating, our EBITDA and cash flow projections both this year and next. And with that, I would like to, I suppose, hand over to Alex, and we can open up the floor and for the panel for questions.
Kit, Chris, thank you very much for your presentation this afternoon. And if I may just bring back all your cameras. And ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the top right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed by our investor dashboard. Alex, as you can see, we received a number of questions throughout today's presentation. And if I could just hand back to you to read out the questions and give responses where appropriate to do so, I'll pick up from you at the end.
Thank you. Here's the first question that we've received in today. In your financial modelling of your base case and cautious case scenarios, at what level does cash or debt, net cash debt, bottom out?
Thanks, Alex. I mean, I will actually just hand this straight over to Chris, so we could give guidance on that.
Yeah, I mean, as you probably see from the analyst notes which we put out today, we're expecting our cash to bottom out at around about the £2 million level, which will be where we are at the end of the current financial year, and we therefore expect to be approaching to be cash flow positive in the next financial year. So it will go up from that for FY27, which is calendar year 2026.
Okay, next question is also on the financials. Have you approached lending institutions to assess their attitude to lending against your recurring revenue streams? Should borrowings be desirable or indeed necessary? If so, what has been the response?
Again, I'll hand this over to Chris, but I think the argument there is borrowings will not be necessary, but they may become a useful backstop to generate should we want to pursue other activities, and that's our thinking on this. But I'll hand over to Chris to be a bit more explicit.
Yeah, that's right. I mean, we have approached borrowing institutions, and we have had indicative offers that if we wanted to go ahead with some borrowing, we could do that. I think, as Kit mentioned, I guess we don't need it in our cash flow projections. We're confident that we won't need to take any borrowings, but I guess there's scenarios there where potentially we may get a large new contract where we need working capital to finance that, or some other kind of acquisition which we may need to use borrowing for that kind of scenario. But in our normal day-to-day activities, in terms of our forecasting, we're not planning to use any borrowing in those scenarios.
Okay, thank you. Question here, going across the pond to the US. Given the opinions of RFK Jr., is there not some concern that opportunities in either the medical monitoring or hospitality industry could dry up overnight?
Yeah, it's an interesting question. I mean, look, I think, I suppose I've been out in the US the last few months as well, actually, before the current administration came in, and so it's been interesting to be in the middle of the mood music. From our perspective, just touching on the hospitality piece. So whilst hospitality is about 20% of our total ARR base, it's actually not a core focus, particularly in the US. And so just to be clear on the core focus in the US, it is the healthcare customers that would be either blood plasma providers or private healthcare companies. or indeed what we call senior living. So on the health, that's the healthcare side. So the senior living use case is actually very interesting for us. So, a number of our net new logo acquisitions towards the back end of last year were actually senior living, so care homes. Typically, there are, and there's quite a significant amount of private equity ownership within that. It sits on our sweet spot of being both a high margin industry, but also low digital maturity, and indeed with a frankly growing customer base and growing demand from a demographic perspective. We don't see any indications of that changing, given some of the characters in the current administration. But of course, look, in the very, very near term, and we're talking, month to month, there might be some contraction or some length of sales cycles, as frankly, everyone makes sense of what the week's latest policy is. So we don't anticipate there being too much direct impact onto our business. And the majority of our medical monitoring blood plasma customers are secured from a contractual basis, 3-year terms. So that gives us a good foundation to build from.
Thank you. A question here about the Dishoom contract. How long did it take to get from 5 to 13 locations, and how many are there for you to go for? What product technology did you displace?
Yeah, I use this as an example. I use this as a way of talking about just the land and expand model for someone like CHECKIT in the space that we play in more generally. So in terms of Dishoom, I think we're in all of their locations. So 13 is all of their locations, certainly in the UK, although they have announced they're expanding to the US. So that could be quite exciting for us. And that was achieved over a period of about 3-4 years, maybe I think just under 5. And again, what product tech did we displace? In common with a lot of our customers, more than 50% of these are what we call greenfield locations. So there was no product tech in place beforehand. This was a forward-thinking organization that understood it needed to embrace automation and digital to both get cost out, but also to enhance customer experience and indeed employee retention. So that's a good example of someone like Dishoom. I think I might even expand this example and talk about someone like BP, where I said we're in just over 1,000 locations, including all of the UK service stations, Netherlands, Luxembourg, and also, as Chris mentioned, we rolled out across, I think, some 400 locations last year in Australia and New Zealand. That was also an organisation, BP, that didn't have a tech footprint for dealing with retail operations. But since we've rolled out the CHECKIT platform, we've built various ML and AI tools on top of this, one of which would be a proprietary tool called CPM, which enables BP to be much more forensic around production planning. So this is their ability to forecast what the product demand will be by service station, by location, by time of day, by time of year, thus minimizing the amount of wastage in terms of stock, and also allowing to I suppose, positively influence their revenue footprint. And this is very, very valuable for a customer like BP. And indeed, they've said to us that a few times they've looked to see whether there's a comparable tool on the market, given what we provide, and they haven't found one. So this is a good example of what we would call an aspect of hardware-enabled SaaS plus SaaS, and then you start building products on top and you get a sticky customer.
Thank you. On the revenue front here, £200,000 of new customer ARR in an entire year is poor. What makes you think that sales can deliver what they need to in FY26?
Thanks, Alex. Well, I mean, the first thing I'd say is I don't think it's actually poor. As I said, our sales performance of, I think, 2.1 million total ARR bookings in the year was up 33%. And in terms of net new customer acquisition, actually that 200K is spread across about 5 or 6 customers. So actually on an average size, that's sort of 35, 40K's worth of ARR per customer. That's actually not unusual for this type of business. Remember, this is a business for which you're very selective about the types of new customer you bring on board. You'd rather bring on board one BP customer or BP equivalent customer in a year and then expand it over 3 or 4 years than bring on board lots of small, low margin, non-expansionary customers, which then become churn risks down the line. So that's very much part of our strategy. So I think it's actually, the question is, what's the type of customer we bring into the pipeline? And so by talking of the pipeline, and we haven't mentioned it in the slides, but our pipeline is sitting at just over £16 million of ARR. So that's about £48 million of total contract value. That's the most healthy it's been since I've been in the business. And indeed, within that pipeline, there are more mid to large size opportunities than we've ever had. And as Chris has mentioned, we're exceptionally conservative in our modelling of how that will flow through. So the hope and the pressure on the system is to then find a way to beat the expectations we have in the budget. And so that's how we'll do it. We spent a couple of years building up the go-to-market infrastructure. So we've got the right leadership, both in Europe and indeed North America, and indeed the right salespeople and the right supporting assets around it. And so that's why we have confidence, even though we're going to take the amount of cost out of the business that we're talking about, we're actually retaining the sanctity of that infrastructure to allow us to be able to beat. It's more of a question of timing, I think, and phasing, particularly given what's happening in the market. And that's something that's not entirely under our control.
Got a question here which sort of linked to that. So you've answered some of the parts, but I'm going to ask it because it's probably worth reiterating some points here. How can you be happy with the drive towards profitability when it'll only be achieved through the 3 million cost-saving initiatives? And was this always the plan, or are sales down versus forecast?
Well, as I mentioned, sales are actually up versus forecast. We had a strong year last year, and we'd expect to be able to deliver something similar this year. Although the timing, the phasing out may not be fully within our control. I think the fact that the macroeconomic conditions are so volatile, and the fact that actually there is a premium placed upon profitability, and this is something we've been working towards over the last couple of years, have made it quite clear that actually prioritizing profitability as a main effort under those circumstances, that's a lever that we've got control of. We've got full control of it, and so we've lent into it quite aggressively. And so that's, for us, is from a board perspective, is the necessary action to take whilst retaining the sanctity of the rest of the business.
Thank you. I think we've probably got time for one more question, so I'm going to ask that now, and apologies if we haven't had time to ask all the questions that have come through. But last question here is, what's the principal objection of potential customers to adopting a service like yours?
That's a good question, right? I think when we don't win a deal or we lose a deal, it's quite rare that we're losing a deal to competition. So this is, it's quite a fragmented space. I mean, the principal objection will still be, I think, associated with inertia. So these are customers who are making their first step into the digital and automation world. They're very used to doing things the way they've always been done. That's the typical question. And you're still spending money, so you need to demonstrate a really strong ROI statement when you're selling into these customers. Some of them are more mature and they get it and they understand it, and then you can lead into it. Some of them are more cautious, and I think the operational environment that they're working under, they've got tensions to balance. So they might have budget allocated, and then they have budget removed quite quickly by an aggressive CFO. So that's something that we come across from time to time, and we see long sales cycles. This is an industry which has very long sales cycles, but once you then get in, it becomes very sticky, particularly with our product set. So this is something that you incrementally build over time. You land, expand, you bring in the right new customers, and we've become very focused on how we execute from a sales perspective. So that's our main effort.
Kit, Chris, thank you for answering all those questions you can from investors, and of course the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Kit, could I please just ask you for a few closing comments?
Yeah, thanks. I mean, look, as I said, we're not only happy with the performance we've delivered in the last 12 months, but we're actually very excited about the prospect for the business going forwards, particularly given some of the measures we've taken by way of profitability. And this puts a really firm foundation from which to then re-continue our focus on top line growth. And we'll be excited to keep people updated on how that's performing as the year progresses.
Kit, Chris, thank you for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of CHECKIT PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.